Welcome to the Unfettered Wealth Podcast with Eric Tashlein from Connecticut Capital. In this podcast, we help business owners and successful professionals plan for better wealth outcomes. Join us for this journey where we explore ways to help you identify better wealth decisions to help you achieve an unfettered life. It's time to ask yourself, what do you want more of?
Hello and welcome to Unfettered Wealth with Eric Tashlein. Eric, good morning.
Hey, good morning, Eric. How you doing?
I'm doing fantastic. I know that you have a guest on the show today.
I do. My business partner, Brian Parke, is here, and we're going to talk about some really exciting stuff today.
All right. And you gave me a cheat sheet. You're talking about job transitions. And I think coming out of 2020 and moving into 2021, I know we saw a lot of people with job transitions due to all sorts of circumstances. So I think this is both timely and important for people to learn. So I'm ready to listen.
Definitely. You know, what we notice on social media, especially LinkedIn, it seems like, as you're saying, every week we're seeing people that have left their old employers. And so Brian and I just wanted to go over a checklist because there's definitely money being left on the table. And I'll bring Brian in, and I know he's got some great points to add to the conversation. So good morning, Brian. How you doing?
I'm doing well, Eric. Thanks for having me back.
Absolutely. We enjoyed your last cast, and it's always good to have you here in the building. We've been spread out as an office for a while, so it's always nice. I was bringing Brian dropped his car off this morning, and I drove him into the office. I was teasing him. I was like, "Oh, here's Milford Harbor, Brian, and here's some of the downtown." It's been a while.
Yeah, a lot has actually changed since the last time I was down here. So it is actually a little bit of an eye-opening experience sometimes.
So we're heading into Valentine's Day weekend, and of course I have to ask what you're thinking about getting for your lovely wife.
Well, so don't tell her, but I'm planning on getting her a sushi dinner because it's one of those things that she loves but never has, and so I'm going to try and surprise her with that.
That's awesome. That's thoughtful. Sushi, that's one of the things in our house that everybody agrees on. And that just never happens anymore. I think my youngest daughter could live off of Chipotle if we gave her the choice. But sushi, I think I may steal your idea if you're okay with
well,
that.
hey, it's always a good choice if you like sushi. And I don't think my kids have had it yet, so it'll be an interesting experience to see how they enjoy it or not.
You may not want to introduce him. It's an expensive hobby.
True. Good financial wisdom there.
So today, Bryce, I know we've been talking a little bit about job transition. I think we're both in agreement. People tend to leave money on the table. And so we just wanted to give folks a checklist and maybe lessen some of the stress during that time. So if you wouldn't mind, we're going to talk today on the cast about health insurance because, that's a big one. We're definitely going to hit on your 401k and pension and some of the key things you need to address within that. And, there's a list, and we'll talk about stock options and relocations and so forth. But on the health insurance front, Brian, what are some of the thoughts you have in that area?
Well, sure. So, health insurance usually is something that people are thinking of. If you look at a lot of times people, when they're evaluating a job transition, the key things that they're looking at is first and foremost compensation. Does this make financial sense for me to change jobs? Oftentimes it's also looking at quality of life features. How close is it? Is it going to require a move? What does my lifestyle look like in making this job transition? And then also the next one is health insurance. And, what does that look like? Because depending on where you are currently and where you're going, health insurance might be a very different picture depending on if you're in a union job, if you are a corporate Fortune 500, if you're working for a school. All of these have very different plans and different, benefits that go along with them. So health insurance from that aspect usually is on people's radar, but I think a few things that maybe not be on their radar would be for instance, if you are on a high deductible plan, typically you have a health insurance, a health savings account tied to that health insurance plan. And so depending on where you are in the year may influence how you go about your transition if you are in fact going to be moving forward with a job change. Case in point, if you are early on in the year, it may not have too much of a material too much of a material impact on how you make your transition. But say you're late in the year, say you have most of your deductible met or all of your deductible met. If you're about to change jobs, it may be very wise of you to, look ahead and say, okay, well, what type of medical expenses might I be incurring in the next few months, and maybe accelerate them. We've had these conversations before where there are maybe some lingering health things that you just never feel is the right time to take care of. Well, this may be the time to do it.
Right. And I know we'll talk about it later, but also in conjunction, maybe you have some vacation time saved up and some sick time saved up. So I think it's just a great combination to address, multiple parts of this transition process.
Yeah, I mean, timing, you'll notice that timing seems to be a reoccurring theme through this, but certainly looking at where you are in your schedule and certainly what type of expenses might be coming down the road is important to look at. Actually, and speaking of schedule, for those who might have some sort of vesting schedule or retirement schedule for benefits paid in retirement, health insurance paid in retirement, either all or a portion of it, those are things to keep in mind as well. Let's just say you're coming up on a milestone for attaining one of those benefits. You may want to think long and hard about leaving before that. Eric, I think you had mentioned it's kind of like a pension that's been earmarked for your health benefits. And so leaving that on the table with a premature departure may be just a poor choice in the long run. Certainly, there are other factors that go into your decision to change, but you certainly should give consideration to it.
No, I think that's great. I mean, because obviously, if you have a vested health plan, I mean, to me, that's hundreds of thousands of dollars, and hopefully you time it right. In terms of flex spending, Bri, I mean, I know that's something that comes up a lot. I didn't know if you had any thoughts in that area as well.
Yeah, so flex spending tends to be more common in larger plans, so you'd see it more in corporate plans. And it may not be something that everyone intuitively knows what it is. So just for those who are maybe unfamiliar, a flex spending account is a tax-advantaged account that is funded with pre-tax dollars. So the whole purpose of this is to be able to spend those contributed dollars towards your healthcare expenses over the course of a year. The plan is a use it or lose it type of plan. So when you're looking at transitioning to another job, you might want to look at what your flex spending account looks like. If it's running low, might be a good time to change that job. If you just funded it, again, that might be one of those things that you could give some pause to, because if you leave, you are going to be potentially leaving some money behind.
And from I've seen over the years, and every they can differ, but it's usually on the date you leave. You can lose the benefit, or it could be at the end of the month. So if you have prescription glasses, you haven't had a physical exam, and like we talked about earlier, if you have something, from a health standpoint that you could use that account for, again, you'd want to get on top of that.
Absolutely. And now it's important to note too, Eric, that the flex spending is different than an HSA. And so typically you see people maybe confuse those two. An HSA is a health savings account. Those are linked to high deductible plans. We referenced that earlier. And the HSA is portable. So if you do have a well-funded HSA, that is not something you should be concerned about losing. You can use it with another high deductible plan. And even if you're not going to another high deductible plan, let's just say you're paying a copay, you can just retain the HSA behind the scenes. You can even use funds for expenses that qualify, but you don't need to worry about losing those funds. The important thing to remember too with an HSA is that you have to have the pairing of a high deductible plan to be able to make contributions. So don't make the mistake of going to a different plan and not having an not having a high deductible plan and making contributions. But it doesn't mean you lose the money.
It's funny with the HSA. We've had one for our family for about probably the last 8 or 10 years, and I really do wish just as an aside, I wish they could expand the amount of deductibility, because when you have kids, between orthodontia and just all these checkups, and the old guy's got a prescription or two as well. I mean, our balance literally is zeroed out every year. So I'm I'm hoping someday they go to the $50,000 deductible HSA, but it's probably not going to happen.
Well, two things. I'm looking forward to the day where I could actually do a $50,000 contribution, but I agree with you. It is one of those money in, money out situations. So certainly it's one of those, it's good when you use it a lot or not at all. The ones that use it somewhat is where it may not work the best, but I do find that we use it quite often. So it's been working for us.
No, definitely. So on the other big issue that we see all the time, and this is where I think you'd want a professional on your side, is, making your 401k and pension decisions as you're leaving the old employer. So Brad, do you want to hit on some of those, please?
Yeah. So a few things that may not be top of mind when you're evaluating the transition is, first and foremost, if you have a loan balance, you may want to give some consideration to trying to pay that off either more aggressively, if possible, or completely, because what happens in a situation of a departure, either, just so you know, whether it be your choice or not, if you leave your employer, you are required to pay back the loan, and it varies in terms of the time there, but you are required to pay back the loan pretty quickly thereafter. And if you default on the loan, it actually is going to be taxable income in that year. So it is, certainly something to be aware of. The maximum loan you could have based on regulation is a $50,000 loan. So it's no small change. If you do have a loan out there, potentially it could be a large tax bill. Another thing to consider with respect to when you leave is tied to your profit sharing contributions from the employer. And so many times you'll see within a plan document that is written that all of the employees who are employed at a certain point in time are eligible for the annual contribution. And so with that, you want to make sure that you're on that short list. If you leave before that date, even though you may have been there for a majority of the year, your contribution will not be paid to the plan.
Yeah, definitely. Then, obviously you have these, vested and non-vested contributions potentially that have been made in the plan, and that's another area. And that's why I think it's important. I mean, this is one of those dry areas that, if you're a busy executive, you're working 50, 60 hours a week, you have other obligations, this is a good area to bring somebody in, because you really ultimately, we end up reviewing plan documents, we end up getting on the phone sometimes with HR along with the client. So I think people really need to get it right when it comes to this, because again, one of the big issues we see are people just leaving thousands of dollars on the table.
Right. And that's a good point too, Eric. Not only just for that year's contribution, but also another thing to check is if you have been receiving contributions from the company that are elective, that they don't necessarily have to give you. Oftentimes those are put on what's called a vesting schedule. And so when you look at your account statement every quarter, you should probably be seeing something that says, here's your account balance, but then here's your vested balance. And if those two numbers are different, that means you're not fully vested. And you could potentially be leaving some of that money behind when you leave.
That's a great point. One of there's a decision that everybody needs to make ultimately. It's, do you leave your 401k at your old company? Do you transfer it? Do you roll it to an IRA? And these are, again, some areas you really want to sort through. And Brian, I don't know what your feelings are on this, but I think we've seen a lot of people just automatically move plans to an IRA. And I was hoping maybe you'd speak to that.
Yeah, I think, people have been conditioned to think that they have to do something. And I think first, let's just dispel that, because outside of a few exceptions, you do not need to do anything with your 401k. In fact, you can actually just kind of put that aside in terms of things that you're having to worry about in the here and now of getting set up with maybe a new job. You're signing up for all these benefits, you're getting yourself enrolled, you're having to learn, the ins and outs of a new job. Right then and there, you're not looking to add complexity to your life. So get yourself settled in, then you can evaluate what to do with that 401k. Is it best to just leave it at the old plan? Is it best to roll it to an IRA, or you could even move it potentially to your new employer's plan? And you definitely want to, and as you said, Eric, it is important to bring someone in who's experienced with looking at these types of nuanced things. Which plan is better is a hard determination to make if you don't know what you're looking for. So comparing plan funds, potentially the fund expenses are coming into play. Are they commissioned in any way? Yeah, so it's important to go through your options, bring someone in who's accustomed to looking at the differences in plans, and then just make sure you make an informed decision. It may be best to leave the plan where it is, or you may want to move it to the new employer because their plan has a lower fund expense on average. So just make sure you're making the choice that's right for you.
Yeah, and what we find is, I mean, oftentimes there are certain unique benefits within the 401k and profit sharing plan that you can't get in an IRA. And, one of those is a stable value account within the plan. And in a low interest rate environment, sometimes that's a lot more attractive than some of the bond or cash alternatives that are out there. So many times, I don't know if it's a third or a half of the time, we'll have clients keep their monies at the plans. And I think, sometimes we'll, when they leave it at the plans, we'll end up skewing it towards stable value. And then, if we are handling an IRA on the side, we'll skew higher to equity. So those are just some of the nuances of financial planning that we employ as fiduciaries. And as Brian said, I think just it's an area that you're going to want some help. And just, we do see a lot of advisors just solely recommending to move the money. And honestly, I just don't think that's in your best interest half the time.
Yeah, it's a very common misconception, one that I think people have been conditioned to just expect that that's something they have to do. I mean, I think we can all recall that there was many companies out there that were touting, did you forget about this old 401k? You should roll it over to us.
Right.
You don't see those as much now because you're starting to see some regulations come out as part of their efforts to make sure that people are making good decisions, financially sound decisions that aren't just based on the marketing campaign of a given company.
Right, and the last thing too, which it's a dying breed, but some of the listeners have a pension. There's a formula there. There's timing, and oftentimes the longer you stay with that employer, the richer the benefit. So we'd encourage you. Usually, as part of our process, we'll have you ask for a plan document, ask for some projections as well, and I think that's helpful as part of a robust financial plan. And in terms of some housekeeping on the 401ks and pensions, some last things to think about is definitely, if you happen to have a small balance under 5K, plan on your old company jettisoning you at some point, and just be prepared to move that money. So they're not held to the standard of keeping that money if it's a small account. And then also just a reminder to change your address, right? We've seen over the years, I can't tell you, at least once a year I'll go onto this Connecticut big list, which is unclaimed assets. And, we'll see some client accounts, from a previous life before they met us there. Sometimes I'll see one of my buddies' family members there. I'll just do it sometimes just as a service, just because I'm wondering, how it's like dialing for dollars. Like, how much have they left on the table? And it's kind of fun, but just don't do that to yourself.
Yeah, you're a good man for that, Charlie Brown. I think that's a very important point to remember too. If you don't change the address or at least your contact information on an old plan, it's hard to get in touch with you. I mean, we've had plans where we are working with the plan, and it's hard to reach out to people. Sometimes they've moved not once but twice since leaving the company, and it's like you almost have to hire an investigator just to find someone to let them know their money is here.
Totally. No, that's definitely true. So, those are the real the heavy hitters of transition, but there are some others. I know, Brian, you were going to hit on stock options a little bit. Any thoughts there?
Yeah, I think with stock options, there's a couple points that I think are just important to remember, and I don't think it's all overly complex relative to how complex stock options are. The first and foremost one is just, again, going back to timing, understanding your vesting schedule. If you are close to becoming vested in a tranche of stocks, you just don't want to leave prematurely and miss out on that. We've seen people do that in the past, and those options ultimately became pretty valuable, and they, of course, did not get fully vested in them. And the other thing, too, is once you leave your employer, those options, once you are vested, are yours, and it is your responsibility. No one will be keeping tabs on this other than you to remember that those actually do expire. So the worst case scenario is you have some valuable stock options that you just forget about. and let expire. And then all of a sudden you are finding in your file cabinet that you had these options. You look it up and you have a mild heart attack, realizing how much money you just potentially lost.
Yeah, thankfully it's never happened to our clients, but we've heard about it.
Yeah, we've heard some horror stories for sure.
So on the some other things too in terms of housekeeping, group life, group disability, most everybody has it at employers. If your health has changed, one thing just to be aware of that, when you transition to the new company, you may or may not be eligible for higher amounts. So just be aware that with group life and group disability, oftentimes you can convert some of that to a permanent plan. They're not always the best plans in the world, but they are convertible. And so just keep that in mind if you've had a couple larger dings to your health situation. One of the things also, which I researched as part of the podcast, was relocation, and I didn't realize the costs were as high as they were suggesting. If you're a renter, it's suggested these days that $20,000 to $30,000 is not unreasonable for costs of transitioning out of state. And if you own a home, sometimes new companies are going to pay for the realtor commission and moving and so forth, and maybe even contribute towards the cost of a new home in some cases. But those costs they're saying are 70 or 80,000 is not outrageous. And I just haven't dealt with that with a client recently. I didn't realize the costs were that high. So just be aware of that. Keep your receipts. And Brian, I'm not sure if you have any other thoughts on that.
Yeah, well, you kind of touched on what I was thinking there is that, keep the receipts. I mean, oftentimes you do see at least the new employer is going to contribute in some way, shape, or form as to the, covering some of the costs or sometimes all the cost of a move or any of those incurred costs. But just as a backup, oftentimes you do find some tax benefit to being able to claim on your next filing. So keep the receipts, make it easier on yourselves, organize it prior to it going in the box. And then hopefully next April, you're not having to struggle finding these things. But certainly your new accountant potentially will appreciate the efforts.
That's good advice for sure. The other thing too is it's suggested definitely update your social media right away. Don't wait too long. It's it's kind of frowned upon. And I think the last 2 or 3 items, paid vacation, which we kind of hit on earlier, right? I mean just be aware that if maybe you give your 2 weeks notice and you think that you're going to use some of your sick time or what have you. Well, sometimes employers will just kick you out as soon as they know you're leaving. So, be aware of how much vacation you have left, how much sick time. One thing that you brought up earlier was really important as well. If you want to hit on the college reimbursement, Brian.
Yeah, so with college reimbursement, which is becoming a trendy perk that employers are offering, the key thing to remember is they may be paying for your MBA, but that's also a retention tool for the company. And so if you were to look at the fine print of maybe your employment contract or that benefit in particular, very oftentimes there's a certain requirement for you to work with that company for a stated amount of time. And so if you leave prior to that date, then there could be a clawback on some of that tuition. So you might be thinking that you're getting a huge raise by jumping ship and going somewhere else, only to find out that that's eaten up by the tuition bills that you have now had to pay back.
I think that's it. I mean, I'm not sure, Brian, do you have any other thoughts in terms of our listeners, in terms of the transition process?
Yeah, well, so one thing that I think oftentimes is a little tricky for anyone who's trying to evaluate a new transition and gather information from the current employer is that you don't want to be tipping your hat that you are potentially headed out the door. And so I think sometimes when you're looking at, requesting a document, you don't want to be specific and say, hey, when is that date that I need to be here by to get my profit sharing? It might be a little obvious. And so what you might want to do is just lean on the financial planner that you're working with. He wants to get a copy of the plan document so that he can help with planning my retirement. The requesting of the pension formula can just say, I'm working with a retirement specialist. He is looking at how this looks 20 years down the road based on me working to 65 or whatever you would like to state.
That's great.
But just put the request onto the financial planner in this case. It's coming from them. There's no need to worry. In this way,
listen,
you're not
how
under pressure.
often... No, that's great advice, because how often are we the bad guys, right? It's like, we're the paper target. Now just blame us. Tell your children that, the $400,000 or $500,000 college tuition loan it needs to be absorbed partially by them, and my financial planner told me I had to tell you that, right? And among other
Right.
cases.
Yeah, you can abuse us as much as you wish with that type of stuff. Absolutely. It works because it's a completely legitimate request when you're going to your employer. They get it all the time, but it's wise to not necessarily indicate that you are about to leave.
So that's it, Brian. I thank you so much for being on the podcast today. And I think Eric Johnson's going to come in for our close.
Absolutely, guys. This is great information. I love the fact that you're open to being the bad guy. It's important for people to be able to lean on the professionals in their lives to help them through whatever they're facing. And the transitions are a huge issue, and could be pretty stressful. So I love the fact that you're very open to that. Guys, just fantastic podcast today. Eric, thank you so much for bringing Brian back on the show. Brian, always a pleasure to have you here. I hope you come back.
Absolutely. I look forward to it.
And if anybody is facing something like this or considering something like this, like you said, lean on the professionals. I agree. If they want to lean on you guys and reach out to you, what's the best way to get a hold of you?
I would say just go to the website. We get a lot of booked meetings through that service. And so it's ConnecticutCapital.com. Certainly you can give us a phone call, 203-877-1520. And I would really encourage folks also, if they haven't done it, to subscribe to our podcast. Mm-hmm. And I do feel like the information we're putting out here is really valuable. So I'd love for them to sign up.
I agree 100%. And we just want to thank you for listening and tuning into the Unfettered Wealth Podcast with Eric Tashlein. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Eric comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks so much for listening today. For everyone at Connecticut Capital Management Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Unfettered Wealth Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Connecticut Capital. The content has been made available for informational and educational purposes only. Content should not be construed as personalized investment, legal, or tax advice. Please consult your advisor, attorney, or tax advisor in regards to your individual situation. Eric Tashlein is an investment advisory representative of Connecticut Capital Management Group, LLC, a registered investment advisor. Connecticut Capital Management Group, LLC, and Connecticut Benefits Group, LLC are not affiliated.